Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at three tech stocks that are trading 40% or more below their highs to consider buying in June. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into the three stocks, which I will tease out, are Intuit, Garmin, and Paycom, we're just going to go over the broader market to give a sense of maybe why we're going to look at these three stocks in particular today. So there have been plenty of fantastic large cap stocks really on sale at the moment and throughout 2023 because a lot of investors have been gravitating towards these big tech, mega cap tech names like NVIDIA and Meta. So there's tons of these stocks out there, and the S&P 500 climbed again on Thursday and was up through early morning, mid-morning trading on Friday with that debt ceiling deal now out of view. It seems like it's going to head to Biden's desk after the Senate rushed through to pass it already. So this is ahead of the Janet Yellen's default date, which was going to be Monday, June 5th. So it was great to see this finally get out of the news cycle. The deal was always going to get done, but Washington politics can get in the way and make things a little more interesting than they probably should be. So with that out of the way, now people can focus on the fact that the two jobs reports, the one on Thursday and then the Friday morning jobs report, came in rather hot. So the jobs market remains strong. It is worth noting, though, that Friday we saw that the unemployment rate did jump up to 3.7% from 3.4%. That is due to the fact in some part that more people are entering the labor market, which is a good sign. So it'll be interesting then to see what the Fed does in June and all of this. But overall, things are still looking really bullish. The S&P 500 and the NASDAQ continue to march higher. They're staying well above that 50-day moving average. But as we've started to see more and more that NVIDIA, Meta, Apple, Tesla, these really big mega cap tech names have driven a lot of these gains. So there's a ton of stocks in the S&P 500 that are still in the red in 2023 in trading or have not outperform the S&P 500 by any means. So there's tons of names out there that are sitting at attractive levels that are far from overheated. I mean, it's kind of difficult to think you want to chase NVIDIA at these levels. I mean, there's no telling if you're a long-term investor, but we're going to look at some tech stocks that have not participated as big in this 2023 rally that are still trading 40% or more below their all-time records, that boast strong proven business models that you might want to consider buying, even if there's some more near-term uncertainty. So if you're a longer-term investor and you can stomach maybe some unknowns in the coming months of what the Fed's going to exactly do and how inflation comes in over the summer, these stocks could be looking quote unquote cheap in years down the line. So the first stock we're going to look at today is Intuit, which trades the ticker INTU. So the company is most known for its software that focuses on taxes. So it TurboTax, online tax hub. It also sells software geared towards accounting, small business money management, personal finance, which includes QuickBooks and Mint. The company also spent the last several years deepening its roster to make it more attractive to a wider array of customers and business clients. So the company bought Credit Karma and MailChimp. It brought Credit Karma back in December of 2020 and then MailChimp in November of 2021. So that was during that COVID boom. So now alongside TurboTax and accounting and other financial services, the company has email marketing, digital ad services, customer relationship management tools, more credit score stuff like that, and more personal financial offerings. So just much more robust software offerings that are helping it bundle packages to various business customers and regular retail users. So Intuit, which lands a Zacks ranked number 3 hold at the moment, boasts over 100 million customers worldwide, and it grew its revenue between 11% and 32% for the trailing 7 years. So that highlights the stability of its business model, because the one thing that saying goes, death and taxes, people are going to always need to do their taxes. So just that TurboTax software alone is a great business model, and it just shows that stability. And then most recently, the company posted strong Q3 FY 2023 results on May 23rd, and this came after it blew away Q2 results in February. So the firm provided also upbeat guidance in May, raising its total revenue, operating income, and earnings per share guidance for the current fiscal year, which is 2023. As I said, though, they already reported their Q3, so they're far deeper into their fiscal 2023 than the regular economic calendar. The company also boasts a strong history of earnings beats, and its current year, so the 2023 earnings estimate's up about 3% since its release, and the 2024 is up about 1%. So some positive earnings revisions there. And then its most accurate estimates, which are the most recent Zacks estimates, are coming in above consensus for both 2023 and 2024, which is a positive sign. And then looking ahead, Intuit's revenues projected to climb by over 12% in 2023, and then another 11% in 2024, to come in at nearly $16 billion in fiscal 2024. So this would extend its streak of double-digit sales growth to 9 years running, which is really impressive. And then its adjusted earnings are projected to climb by about 19% in 2023, and then another 10% next year. And now we're going to get into the share price and some of the valuation, which is really where people might start to be attracted to Intuit at the moment. So Intuit shares have more than doubled the Zacks tech sector over the last 10 years, up 620% versus 265%. And this outperformance is even more pronounced if we look over the last 20 years, with Intuit up about 1,400% versus tech's 300% climb. The stock's also still up 100% in the last 5 years versus tech's 75% climb, yet investors can scoop up INTU, which is the ticker. It shares 17% below their average Zacks price target and roughly 40% below their record highs. And we should note that in terms of some technical levels, the company had its golden cross back in March, so that's when the short-term moving average crosses above the longer-dated moving average, and it's currently stuck in between its 50-day and 200-day moving average, but we're seeing some positivity in terms of the stock possibly breaking out of the range it's chopped around in for much of the last year. It's now up just around 4% over the last 12 months, and it's hovering at neutral RSI levels. And then in terms of valuation, Intuit is far from cheap. It's trading at 42.5 times forward 12-month earnings, so about 43 times forward 12-month earnings. Obviously, most people would never consider this cheap, but it's now trading pretty much right at its median over the last 10 years, and this is considering that the stock has continued to climb higher and higher and higher and outpace tech, and it's now trading at a 50% discount to its own highs, which it got just pretty overvalued during that COVID boom. So it's maybe worth considering Intuit at these valuation levels. It also has a sturdy balance sheet. It pays a dividend. It's been buying back stock. And on top of that, 19 of the 21 brokerage recommendations that Zacks has for Intuit are strong buys. So that just kind of shows you how positive long-term Wall Street is on Intuit, even though the stock is still trading around 40% below its peaks. So certainly worth considering Intuit because, as I said, it's been bolstering its business, and its core offerings of tax services and accounting services are not going out of style, and everything's done online. So Intuit certainly worth considering as a longer term play. This another stock, obviously less massive than Intuit, but Garmin. It's best known for maybe its customer-centric GPS systems, but it's much more than that. It sells advanced radars for airplanes and boats and beyond. The stock faced some tough to compete against periods. Some of it was that COVID boom and spending on fun things like GPS and boats and things like that. So we'll dive into the business and then kind of look at some of the other fundamentals. So Garmin has been at the cutting edge of the modern consumer-focused GPS movement for years. The firm's in-car navigation system, fitness wearables, smartwatches are kind of staples still in our connected world, and this is despite everyone having an iPhone or some other device that easily is able to navigate to where you're going. So along with those everyday consumer electronics, Garmin sells high-end fish finders, advanced radar systems for boats and airplanes. It even has deals with a flying taxi company. So it's not just some simple something regular people use. They also have a really advanced radar systems and stuff like that. So its diverse and compelling offerings have helped the company post 6 straight years of revenue growth with double-digit expansion in 2019 and 2021. So it saw its revenue climb 19% in 2021, which was its best showing in over a decade. The firm also posted 4 years of double-digit earnings growth between 2021 and 2018. And the firm's 2022 revenue did dip by around 2% as it came up against those really difficult to compete against periods, and its earnings slipped by about 12% also against that really hard to compete against stretch. And then in terms just of where that revenue is coming from, it's worth quickly noting that in 2022, the outdoor segment, so its outdoor segment accounted for about 31% of total revenue, with its fitness segment coming in at about 23%, auto at 11%, its marine division coming in at 19%, and then 16% for aviation. So very diverse in terms of its segments, which helps it kind of navigate the waters when different of these segments face some near-term headwinds. Garmin then in early May topped our Q1 2023 earnings and sales estimates and provided pretty upbeat guidance. This helps the stock land a Zacks ranked number 2 buy right now, and it's set to return to growth on both the top and bottom line in 2023 after that dip last year. So we're calling for about over 4% revenue growth this year, and then another nearly 8% revenue growth next year to get all the way up to about $5.5 billion. And then we're calling for 2% growth on the bottom line this year, and then another 11% growth next year as it returns to solid double-digit bottom line growth. Garmin stock's up about 200% in the last 10 years. This is versus tech's 260%, so it's underperformed tech, but it's outperformed the S&P 500's run of about 175%. The stock's also up 75% in the past 5 years, and it currently trades 40%, just like Intuit, from its highs, and it just broke out back above where it was trading prior to the COVID sell-off, if you just look at those kind of levels. And now it's back above both its 50-day and 200-day moving average, and the stock spiked higher recently after its May release, so it's even higher above the 50-day, and it experienced that bullish golden cross back in early February. So if you're a technical trader, Garmin might be even more worth your look at the moment. Garmin stock's also trading at 19 times forward earnings. This marks a discount to tech's 24.6 times forward earnings, and also a discount to its own 10-year median and a 36% discount to its own highs. The stock also pays a dividend that's yielding about 2.8% at the moment, so you get that bonus as well. So Garmin overall worth considering for all the reasons we mentioned alongside Intuit. And then the last stock we're to look at is Paycom Software Inc., which trades in the ticker PAYC. Paycom is a cloud-based HR platform. Essentially, they launched back in 1998. It was one of the first web-based, so online-based HR and payroll technology companies. The company aims to make just everyone's life easier at companies, both on the HR side and the individual employees. So they do everything from payroll and HR management, time and labor management, talent acquisition, talent management, things like that. So these are things that companies big and small now use. Every HR department uses this. I can guarantee wherever you work, some Paycom type software is being used to really effectively run companies' HR, no matter what size company you're at. The company's offerings have become really embedded and essential. As I said, to companies big and small, and you really never stop using it once you start. And we'll show that based on Paycom's growth. So the company's done really insane double-digit growth over the last decade. Did 30% growth in 2022, 25% growth in 2021, 14% growth in 2020, 30% growth in 2019, 31% growth in 2018, 32% growth in 2017. You get the point. just massive growth, and it was doing 40% growth in a couple of years before that in 2016 and 2015. So just huge, steady double-digit growth. We saw some pretty impressive bottom line growth as well for Paycom, including big growth in 2022. And then in the first quarter of 2023, the company's recurring revenue climbed 28% to account for over 98% of total revenues, which highlights, as I said, that strength and stability of its business model. The company also surpassed our Q1 earnings and revenue estimates in early May, and it announced at the time that it would start paying a dividend. So the company intends to pay a dividend at an annual rate of $1.50 per share, with the inaugural dividend payment set to be paid in mid-June. The company said in a press release that after 25 years of consistent execution with a focus on rapid organic growth and expanding profitability and cash flows, we are pleased to add another dimension of our capital allocation strategy. So they're still doing huge growth, and the current payout's going to yield about 0.5% at the moment, which is just a nice bonus with a stock that's still going to be doing double-digit revenue growth. So on top of all the growth they've done over the last decade, Zacks estimates are calling for another 25% revenue growth this year and 25% bottom line growth. And then we're calling for another 21% growth in 2024 on the revenue side, and then 21% growth on the bottom line as well. So just insane consistency from Paycom. The company currently lands as Zacks ranked number 3 hold and boasts a strong history of earnings beats, and its 2023 earnings consensus estimates up about 3% since its last release, with its 2024 estimate up about 2%. So some positivity on the bottom line as well in terms of revisions. In terms of the stock price performance, the stock's up about 1,600% since its debut in 2014. This blows away tech's roughly 260% run, and it includes a 170% climb in the past 5 years to blow away tech as well. It's now down though over the last 3 years, and it's trading nearly 50% below its highs. So it's trading around 48% below its highs. The stock is not sitting at the best technical level if you're really focused on some of those levels, but it did just climb back above its 50-day moving average recently, and it's trading 30% below its Zacks price target. So if you're a longer-term investor and you can handle some maybe more near-term volatility for Paycom, it's certainly worth considering this stock 50% below its peaks, considering that it just announced a dividend, it has a solid balance sheet, and it's still going to be doing pretty impressive double-digit growth after almost a decade straight of double-digit growth. Like Intuit, though, it's not cheap. Investors are going to have to pay up for this consistency. It's trading at 41.5 times forward 12-month earnings, but that's 40% under its median and 70% below its highs. So all three of these stocks are certainly worth considering as longer-term plays that have not participated in this huge top-heavy tech rally of 2023. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.